It's the last day of the week here at Question Time, and Steve Brennan, I think we know what that means.
Yeah, that means our weekly recap of DARP, the dollar and rate paradigm, what's going on with the markets. What do you got for us, Joe? What's new this week?
Well, let's talk about that dollar and rates first. That's where we see, in some ways, the least action. So let's look at that first. The dollar was essentially unchanged on the week. I think it was up 0.2% or something like that. So it's essentially unchanged. It's been in this sideways pattern now for almost 2 years, and but it's been in a recent little short-term downtrend. Just doesn't seem to want to accelerate to the downside. It's just kind of hanging in there. A little bit above 104 right now, so there's just not a lot going on there. On the rate side, the 10-year rate is down about 3 bips on the week, which again is kind of nothing. I mean, we traded to 419 this morning, but we closed last week, I think, at 423, something like that. I think it was 420 last I looked. So not a lot of movement there, but more interesting is that you did get more movement in the short end of the curve. The 2-year is down about 13 basis points on the week right now. And so what that means is you're seeing the yield curve steepen. The yield curve is steepening because short rates are falling faster than long rates. That is a traditional indicator of recession. And I think there's going to be, you're probably going to hear people start talking about that over the next couple of weeks if it continues. In fact, I think we're only about 15 basis points from turning positive on the yield curve again. And I suspect you're going to hear a lot of people talk about that. Now, I don't like to go against things that have worked for a very long time, but I'm going to tell you right now, I don't think, let me say it this way, I think a lot of people are going to get tricked again. A lot of people started calling for a recession as soon as the yield curve inverted, which was dumb because the yield curve inversion generally comes quite a bit before the recession. And it's also generally triggered. You usually see a rapid steepening in the curve right before recession. And the reason for that is that the market starts to price in a lot of rate cuts. Well, I don't think that's really where we are. We're talking about pricing in a couple of rate cuts at best right now. And really, the only one that's really priced in is September. Now, I don't know what the economy is going to do between now and then, but I don't see it as being very weak. And we got evidence on that this week. Second quarter GDP was out this week, was up 2.8%. Nominal GDP, if you add in the inflation figure, was 5.1. So you had 2.8% real growth, 2.3% inflation. That's just about what you want. I mean, I can't imagine that the Fed is too concerned that it's 2.3 and gosh, we got to get to 2. I think there is a possibility, although it's very low probability, that they cut rates next week when they meet. But I think you will get a cut in September. But in general, the economy just doesn't look that weak. The personal income and spending numbers this morning were pretty good. Personal income was up 0.2, personal spending up 0.3. The PCE inflation report this morning showed more progress, although I have to say I was a little disappointed in it. The headline number was up 0.1. The core number was up 0.2. I was actually expecting both of those numbers to be closer to flat. Now, the core number was actually 0.18, so it was rounded up to 0.2, so maybe not that bad. But the point is the market didn't really seem to care. We did see other reports during the week, too, that also showed some weakness and some strength. I mean, I think it was some of both. Again, the housing market has been the weak part of the economy here. Existing home sales and new home sales were both down last month. Although I would say on the existing homes, the June number is actually based on contracts that were signed in April or May. I think it's April. So, I think rates were higher then. I know rates were higher then. So maybe that's going to change as we move ahead. The new home sales was down just a fraction. It really wasn't that bad. But the point is that is the part of the economy that's been weak. It is also the part of the economy that gets healed very quickly with lower interest rates. So I think there's the possibility here. Maybe you do get lower short-term rates, lower long-term rates, you get lower mortgage rates, and whatever slowdown we get just doesn't last that long. We've got some other numbers this week. Durable goods came out this week. The headline number looked like a disaster, minus 6.6%. I think that's the worst since, I don't know, March or April of 2020. Yeah, but it was all aircraft. This is a Boeing issue. If you take out X transportation, the number was up 0.5, which was actually better than expected. And this is what we've been talking about, how the good side of the economy may be starting to pick up. Now, look, there's contradictory evidence here. We got a Richmond Fed survey this week and the Kansas City Fed surveys this week were both less than expected. Those are manufacturing surveys. We also got the S&P Global PMI surveys this week, the U.S. version. In the headline, the composite was good at 50, I think 55. The services number was 56, but the manufacturing number slipped back to 49.5. So again, kind of contradictory signals in that the durable goods number was good, but the surveys are still not catching up there. We have seen strength in the Philly Fed, which we've talked about, but it's not showing up in the other regional Fed surveys. And that's going to happen before you can really say that we're starting to come out of the manufacturing type of recession, essentially, that we've been in for a couple of years, trying to work down inventories. So I think that, in general, it was a pretty good week for markets. Markets, well, it wasn't a great week for the S&P 500. This is part of this rotation we've been talking about and expecting. The S&P is actually down on the week right now, down about 1%. And the NASDAQ, I think, is down even more. NASDAQ is down. Let me just pull this up here real quick. NASDAQ down, 2.5% on the NASDAQ. So the technology stuff took a hit this week. However, if you look at small caps, were up almost 3%. REITs were higher. Mid cap stocks up 1 3/4. We saw, bonds were up this week because yields did come down some. We did see gold and commodities were down a little bit, not a lot. So it turns out to be a decent week for a diversified investor. Certainly, we can hope that this continues. I would just say too, it's interesting to me listening to people talk about this small cap rally. There is a lot of skepticism out there. Nobody thinks this is going to last, which of course makes me think it probably will. The market, remember this, the market always acts to frustrate the maximum number of people. And so if everybody's thinking that the small cap thing can't continue, well, maybe it will. One last note too on earnings. The earnings we've seen so far have been really pretty good. And we're seeing a lot of companies that, we tend to be kind of turnaround people. We buy value stocks. Value stocks often are companies that we like, companies with good brand names that are having some kind of problem that we think they can solve. So for instance, we own Triple M. 3M has been a company that has just been troubled for a long time. The stock's been down a bunch. They got a new CEO, and we bought the stock. It's up 20% today. We didn't buy it today, by the way. We bought it previously. We're already up on it. Now it's up another 20% today. So that's a value stock that's starting to work, and that really is part of this rotation too. Another one on that same list, another one we own is Bristol Myers. They're a company that's traditionally grown through acquisitions, and people got worried. I think they were taking on a lot of debt, doing some acquisitions. People knocked the stock down, and we're still down on it, even though it's up 10% today. It's a good company. They're starting to see traction from the new drugs, because this is traditionally how Bristol Myers has operated. They buy smaller companies and they bring in these new drugs, and then they're a marketing machine. And so I think people got worried that maybe they had slipped up or weren't as good at it as they used to be. But today's report certainly belied that. They had a really, really good quarter. And in general, by the way, I think that the pharmaceutical stocks and the healthcare stocks are really turning around here. We've got some allocation to that, but I think we're going to have to take a look and maybe get a little deeper on that. Anyway, in general, look, not a lot changed this week as far as DARP is concerned. The dollar and rate paradigm really didn't change. I will say that we are very close to making a call on bonds, on interest rates, and saying, look, this is a downtrend. We're not quite there yet. I'd like to see a little bit more momentum, but I think we're getting really close. Other than that, things, like I said, are kind of moving in our direction, coming to the small cap side and the value side, which is where we reside mostly. So that's obviously positive for us. And I think too, it's positive for anybody that's a diversified investor. So we'll see how this continues and see if this small cap rotation continues next week.
Think about the questions you have for Joe and put them in the comment section down below.